AI has definitely changed things, and it's changing things every day right now. What we're seeing specifically with AI with practical founder companies, several things. One, we don't think B2B SaaS is dead. So we think that it creates great headlines to say AI eats software. We think software plus AI is the right approach. Software, AI plus data. And so they're harvesting and creating that data moat that is going to help make them defensible. And using the AI tools, why not use the AI tools to provide more automation? That's what we really think AI does, is increase the ability of your customers to automate the use of your product and to get value. And so, yes, every company that we're involved with has some AI initiative. How am I changing how I run my business? How am I changing marketing and sales and finance and customer success using AI? Every company is doing something in every function in terms of new tools and tests.
Hey, everybody. Welcome to the Practical Founders Podcast, where every week we hear an amazing story from a serious founder who built a valuable software company and did it without big funding. I'm your host, Greg Head, and this week my guest is Deepak Sindwani, the managing partner and founder of Wavecrest Growth Partners, a growth equity firm focused on the smaller side of the practical founder game as an investor and a supporter of software companies that get to 5 or 10 million ARR and want some support and maybe founder money off the table, pay off some early investors to grow in that scale zone to get to 20, 30, $40 million. See, I've known Deepak for 15 years, and they're still focused on serious practical founders, primarily in verticals that have been bootstrapped and capital efficient, that want to get to the next level and looking for a great partner to do that. So we talk about what's changing in his model. Not much. You still got to focus on practical founders. What's changing in the world with AI, go to market, selling the companies that someday. It's a lot going on in the growth equity game with Deepak Sindwani. Hey, Deepak, welcome to the Practical Founders Podcast. Happy 2026. Do we still say that mid-January?
Thanks, Greg. Happy 2026 to you, and thanks for having me back.
Yes, it's been a while, 2.5 years. You were on Practical Founders Podcast 49, talking about your growth equity firm, Wavecrest Growth, which was in the earlier stages. I've known you a long time and watched you start it and bootstrap it and grow it, and it's turning into a serious thing. And you're deep in the growth equity game with Practical Founders. It'll be a great discussion today. You've got your vest on. Are you in Boston today?
I need the vest. I'm in Boston, and it's about 22 degrees out.
Yeah, I'm in Park City, and we're praying for colder weather here and snow and stuff like
You need some snow.
Yeah, right. So let's get into it here. For those that don't know about Wavecrest Growth, and we'll talk about what is growth equity in contrast to venture funding and buyout private equity. It is a different animal. It's very practical for a certain kind of founder here. But tell us about Wavecrest Growth these days. I've watched you grow it, and we'll talk about what's core to your business and your investments and how you work with practical founders and what's changing. So what's Wavecrest these days?
Thanks, Greg. Yeah, I mean, this is an important month for us. It's actually our 10th anniversary this month. So big milestone for us.
Yeah.
We started, January 16 with this vision of hopefully being the best firm to help, bootstrap capital efficient founders who've not taken the road most traveled, taking the road less traveled, and helping them in their journeys. It's really about, collaborative business building. That's really the term that we like to use at Wavecrest. And a lot has changed, but a lot has not changed in terms of our approach. Right. And so, our goal is, now we're a little over $1 billion under management, but our roots are the same, helping founders between 5 and 20 million of ARR to get to 3 to 5, 10x of where they are. And now we have a lot more case studies, and it's been a blast in the last 10 years.
Yeah. So you are an investor in these bootstrap founders, maybe the first investor, the first institutional capital. You raise money to create a fund to go invest in practical founders when they're up at 5 or 10 or 20 million in ARR. And, They don't have to raise money if they don't want to, presumably. These are the practical founders I know. But they're saying, I could use money. I could use help. I could use a lot of support to get to the next level. And I want to go there. Not every practical founder wants to go there. Has that philosophy changed? I know you raised a bigger fund. Sometimes that changes the philosophy. But is the size of founder and the style of founder investment changed
No,
as over the
honestly,
last
and
10 years? Okay. Yeah.
that's what we love about it is the consistency. I mean, from the beginning, our focus has been companies that have gotten to 5 million of ARR, 10, 5 to 20 is our range. It's all folks, as you said, they typically are subject matter experts in their verticals. Most of what we do is vertical oriented.
Okay.
These days, even deeper as it relates to data and data moats with AI, which we'll get into, I'm
Yes.
sure.
Yep.
But the goal is they're doing something great. They're growing on average 50 to 60% a year when we invest. And so to your point, they're profitable or break even. They don't need our money. What they really want is hopefully to benefit from some of our scars. We like to say the scars on our backs shouldn't be the
Yeah.
scars on your backs. And so it's really about how do we help them invest in sales and marketing, usually invest in, pricing and analytics and helps create scalability. And,
So
they're
more
already doing
growth.
something more
Yeah.
growth. They're doing something great already. It's your point. They don't need it, but hopefully if we can increase their chances of success, and that's really what it's about,
Yeah.
we can help them get to 20 or 30 or 40 million faster and with a greater probability, then hopefully we've added some value.
And founders who get to 5 to 10 million in ARR, depending on their price point, usually that range, they realize that the getting past 10 million is a different sport. Sometimes they want to sell it and not have to deal with that. Sometimes they keep trying and it slows down and they struggle. But, it's a different sport when you have maybe over 100 employees and senior teams and multiple go-to-market motions and different competition. And you're probably large enough to be one of the leaders in your vertical space, right? And well known. It's like a different sport than the scrappy startup, right? Scrappy savvy thing there. Is that fair?
I
Is that what you're
completely
saying?
agree.
Yeah.
And you and I obviously met during the, Infusionsoft Keep days. And I
Yes,
know
way back when.
Clay, a great founder there, had defined these stages of company growth.
Right.
I think it's very similar in growth equity or in company building in software and B2B tech. 0 to 5 is its own stage,
Yeah.
right? Existence it's an existential question. 5 to 20, 5 to 25 is its own stage, initial maturation. Then we start to see some, transition in terms of the execs that get you to 10 or 20 usually don't also get you to 50. So that, founders need to be thinking about, do I have the right team on the field in each of my functions? Do I have all the right functions as I go from 20 to 50? And then above 50 or 75, it changes again.
Yeah.
So to your point, it really is multi-stage within this journey from 5 to 100.
And your business model is to raise funds, and your latest fund is 450 million, so a bigger fund, but not $1 billion fund. This is still smaller. And you're writing checks, maybe that's probably 10 investments per fund, so 30 to 50 million, something like that. So, a 10 million ARR software company, you're investing in them. Founder can take some off the table, right? And put something in bank finally, the first time. And then they get some more capital to grow. But it's not crazy. This isn't like $10 million, hurry up and spend it kind of
That's exactly
capital.
right. I mean, the practical approach, couple core principles. We
Yes.
only want to back founders who've been capital efficient and been practical. Number two, they're break even or better when we invest, and which to us proves that they care about the business model and the bottom line and not just the top line. Obviously, growth is important. We love growth, but we also think profitable growth is something that is important. We obviously invest and they can spend, and obviously we collaborate with them to grow, meaning we add management, we add salespeople, we add marketing programs, we add customer success, oftentimes investment in products, sometimes add-on acquisitions, which is a different approach I'm sure you've spoken about
Yeah.
on your podcast in terms of inorganic growth.
You optimize pricing, I'm sure, in there.
Optimized pricing. Most $10 million, 90% of software companies at 10 million are mispriced in our view. In my
Right.
23 years of doing this, that's what I've seen. But to your point, about 50% to 60% of the capital goes to founders and their prior shareholders, because they might
Yes.
have doctors and
Right.
lawyers in their cap
Very
table
practical.
taking some chips off the table. And what we like to say is they're white knuckling it when, every day,
Oh,
because
yeah.
every dollar is their own dollar.
Hmm.
And, when they pay for the house and the kids' college tuition, and it feels a little less stressful, then they oftentimes have this beautiful moment where they can look up at the road a little bit more and
Yeah.
hire someone to help them in a certain function and not have to do everything themselves. And so it's the combination of de-risking personally and then de-risking, hopefully, or reducing risk in the next 3 to 5 years through having some partnership and collaboration. That is the goal.
Well, I know a lot of practical founders and interview a lot, and 45 founders in my practical founders CEO peer groups. Right, I'm very familiar with that, and it's very true that if you've got a little money in the bank and you start this company, you write checks into it for a while, and then you kind of get it on its break even, white knuckling, and so forth. Having 3, 4, 5 million in the bank changes your mindset to be able to say, I have a little space. It's not going to keel over today, and we're okay. And it may be some pressures from a spouse sometimes, right? How long is this been? It always takes longer, right? All that thing. So I totally get that. So, what on average, how much goes to the balance sheet, goes into the company to spend more? Like a lot of practical fighters I don't know how to spend, wouldn't know how to spend five
Well, to
million
your
or 10
point,
million. Yeah. Yeah.
that's exactly right. Like, it's not suddenly that someone takes out 5 million and they become a drunken sailor, or they take their foot off the gas, or they work less than the 60 hours a week they're already doing. It's frankly, to your point, it gives them a little space to think, and it allows them to take some controlled bets that maybe they couldn't have done a year ago or 2 years ago, that they've been always thinking about. Oh, if I
Yeah.
only
Yeah.
had another $500,000, I'd try this. But to your
Right.
point, it's about 5 to 15 of primary capital typically,
Okay.
and then 5 to 15 of secondary. Our average investments and we go, by the way, from 10 to 50.
Okay.
So we
Of
invested in this
investment.
company at the end of 24 in Atlanta, and it was only a, 11, $12 million investment. And it's a wonderful company that had been capital efficient, growing, 80, 100% a year in its vertical, subject
Yeah.
matter experts. But
Yeah.
they didn't need money. So they took, 7, 8 million of primary, a little bit of secondary, and now are, investing that and having that space to invest a little bit more. And, we're not pushing them as VCs may to say, go as fast as you can and grow 150%. Otherwise, you're not worth your salt. That's not what it's about. It's about hopefully sustaining your growth rate and maybe making some controlled, bets.
Yeah, sustaining a growth rate as you get bigger is it works.
The
Keep the compounding
denominator
going.
gets
Yeah.
big, it's hard.
Yeah. We've seen that together. I know. So you're focused on 10 to $50 million investments in companies. So that means mostly minority, meaning you founders and their partners still own most of the company, have control, or do you get into the majority side of things where you have a little bit more control?
So we do both, and it's about 50-50, minority,
Oh,
majority,
okay.
but what we don't do is buyouts. So,
Yeah.
as you said in the continuum, there's VC on one end, there's buyout on the other. We're right smack dab in the middle.
Right.
What we wanna see, which is really important, and the number one thing for us is alignment with the founders.
Yes.
And we judge that alignment based on their willingness to maintain at least half or more of their equity in the company.
You require them to have skin in the game, and,
Skin in the game. Gotta
yeah.
have skin. I mean, if it's growing, 50, 60% a year, 30% a year, 70% a year, and you don't want a majority of that equity that you already have, then it's telling me something.
Yes.
And which is basic principles of alignment. But, as it relates to the size of investment, obviously it's sometimes it's majority because look, many of these founders raised 2 million bucks from friends and family, their uncle, the high net worth
Yep.
angel group in their city 7 years ago. And those investors deserve a return.
Yeah.
And so the way we get to majority, and it's like 55% sometimes,
Yeah.
is by providing those investors with a great return and the founders obviously with some liquidity. However, this is the most important part, does not change our behavior. Whether we own 25% or 55%, the goal is to collaborate. The goal is to work together. The goal is to put together a business plan and execute it. Obviously, the founders drive the bus. And so it honestly, to us, is a spreadsheet math. It's not about, it doesn't change the approach.
So you really are backing founders like venture investing, right? You don't want to run these companies,
Nope.
especially deep verticals where they have all the knowledge and 25 years of experience and relationships and so forth. You want to back them. So not all founders want to go through this 10 to 20 million to 30 million, 50 million as the CEO in charge, right? So you're talking to people and saying, do you want to be the CEO, growing to the next level, right? Well, a lot of founders have in their mind when it gets to super scale or whatever, above 10 million, I don't know if I'm the CEO, but you're following those folks that say, I think I could do this.
Yeah, I mean, sometimes it takes very different turns. And, the first company we invested in at Wavecrest was this business named Building Engines. Great
Sure.
practical founder named David Osborne had grown the business over a 10-year period to roughly 10 million of ARR in the commercial property management software space. So
Right.
the software that runs office buildings, retail buildings, warehouse buildings, work order management, et cetera, et cetera, et cetera, many different modules.
Very
And
sexy software.
sorry?
Very sexy software.
Yes, exactly. And, he very sticky, as you'd imagine. And he was in his, mid to late 50s. And he said, I want to run this business, but there's probably a time when I'm not the best guy to run this business. And about a year and a half later, he decided that he wanted to be exec chair and, still owned a huge chunk of the business. And we brought in a mutually agreeable CEO. And that CEO took the business from, by at that time, 12 or 13 to 33. And we had a great outcome in 2021. But that's an example of these founders, hopefully want their baby to be as great as it can be
Right.
and as big as it can be, or and so for them, hopefully it's not about the ego. It's about how do we make success and let me grab an oar and everyone. That's our approach too. Everyone grab an oar and start rowing.
Yeah. And so how do you help founders work with them? I have experience with you on our board, very savvy, very supportive, helped us grow faster. But how do you and your team, now you have a team, you're not dealing with all the founders yourself and the operators inside the business. How do you help in this growth
Yeah.
game?
So number one, though, I love talking to founders. So I speak to the CEOs, almost all of them every week. I mean, it's truly
Okay.
collaboration. But to your point, yeah, I can't do everything. So we've built out a dedicated team we call Wavecrest operating platform and
Yeah.
and the growth ops team. So we have two folks who focus on go to market. They're specialists in sales, marketing, customer success, helping companies make the right investments, put the right systems in, spend wisely at growing sales and marketing, because a lot of folks don't know which channels to spend in or which tools or, what's the
Yeah.
most efficient way to do it. You and I obviously went through that. We have someone who's focused on finance and back office. So how do you make your, finance and back office the best for your stage? Again,
Right.
when you're 2 million, it's very different than when you're 12 million in terms of your needs. Even understanding your customer analytics, for example, may
That's
not be where
tricky.
it needs
Yes,
to
of
be.
course.
And then we have one person focused full time on talent. So making sure we help you bring in the best VP of sales, the best VP of marketing, the best VP of CS, the best VP of finance in your scale journey. So it's really our whole thing, to your point about practical, is trying to be practical with practical value, practical lessons learned. And that's what it's about. It's not about, McKinsey studies about, strategy. It's how do we help you get from A to B and make the investments there. We're about to invest in bringing on someone to help with product and technology best practices and AI best practices as well,
There we
because we
go. Right.
believe that, all companies need to be implementing and embracing AI.
That's right. But you didn't use the word playbook, which is one of the fears of practical founders who build companies, that they're going to sell it and then it's going to be very prescriptive. The spreadsheet MBAs are going to tell you what to do, and the playbooks are going to get handed down from on high, which we hear about in the large, buyout private equity firms. You need to freaking do this, right? And it's not very fun and maybe kills the soul of the business, or, that's the story at any rate. Do you have playbooks, or how do you approach that?
I hate to use that word because of the negative connotation. Let me validate what you just said. And one of my co-founder came from one of those firms that
I see.
has a, manual of 130 things that you need to do. And there's only one way to do it. We reject that
Yeah.
philosophy. Our view is, particularly when you're at 5 to 20, between 5 and 20 million, the businesses need more uniqueness, more customization in terms of how you implement sales, marketing, customer success, pricing analytics. And so we, help them on a bespoke way to figure that out. Now, of course, that can be aided with best practices. So we've
Yeah.
put together 25 what we call Wavecrest growth levers,
Hmm.
which are, in our view, best practices. I mean, they're
Yeah.
not for everybody, but what they do in examples, in price increases as an example, or in customer success org design, or in how to generate more NRR from your business. Those are some of the
Yes.
topics. We have examples of how 20 other companies did it. And
Yeah.
hopefully the goal is so that you don't have to reinvent the wheel. And what we
Right.
try to bring to the founder is, hey, here's some examples. Here's how we think those could apply to you in terms of generating more growth, generating more efficiency in your business. And then let's figure out a way to do it, or maybe not. And
Yeah.
so it's very much to your point about it's what makes sense, not, one size fits all.
This podcast is sponsored by my friends at Lighter Capital. In the last 15 years, Lighter Capital has helped over 600 software and SaaS founders secure simple, non-dilutive financing to grow a little faster without giving up any precious equity to investors. I know the Lighter team well, and several bootstrap founders they have helped have already shared their success stories on this podcast. Simple debt funding from Lighter Capital can range from $50,000 up to $10 million with straightforward terms, no personal guarantees, board seats, or covenants, and up to a 4-year payback period. Go to lightercapital.com, that's Lighther capital.com, to apply and get a quick pre-qualification. Then talk with their experienced team to create a practical funding plan to achieve your goals. Now back to our podcast.
Well, it's a kind of a version of what we do at the Practical Founder peer groups, right? They get to hear how other people are doing it when they get stuck in really hard things that are, they're not getting, they're not moving forward fast enough, and they get to hear other perspectives and choose one they like that makes sense here. So, you say you have 20 investments, working with 20
We've
companies?
done 18 investments, and we've just started to exit some more with those founders, of course, but that's where we are today.
Okay, so you're investing at 5 to 10 to 20 and helping them grow. And your business model is eventually they get to 30, 40, 50, and they're worth a lot more. Their multiples go up. They're all dialed in, and there's still a growth path for them. And the company sells again. Is that typically and pays off you and your investors and so forth and the founders? Is that typically to a private equity buyer on the next turn?
Private equity and strategics. I mean, so 3 sets of buyers, right? Either a private equity firm that wants to own the business because they love the space and the company's large enough to be, quote unquote, a platform for them.
Right.
Many private equity firms own, software. Private equity firms are the largest buyers of software companies,
Right.
have been for the last 5 years. They may have a company that's several hundred million of revenue that is a good strategic owner of a founder's business. So what we call that sponsor-backed strategic.
Right.
That is the second bucket. The third bucket is,
Private equity backed strategic, right? Sponsor
private
backed.
equity-backed
Yeah.
strategic. And then the third bucket is, for example, a public SaaS company or a public tech company. And
Yeah.
so all 3 have been buyers of our businesses. And to your point, there's no perfect formula. And again,
Yeah.
this relates to practicality. When a founder, when a CEO feels like we've gotten to a certain place where it makes sense based on lots of things, competitive headwinds, based on, the macro environment, based on maybe a personal situation, we will help them to optimize that outcome, which is hopefully one of our value adds. And sometimes, by the way, it's happened many times, the founder wants to keep going after 5 years or 10 years. In which case, there are many different, solutions that you can create. You can create a situation where they can say they took 2 million out when we invested, they can take 10 million out 4 years later and then keep going. and keep
Right.
building the business. And
Because there's a new investor coming
new
in and
investor comes
yeah.
in, we may stay in so that we have a business, two businesses where we stayed in with half of our stake and stayed on the board and stayed supportive and brought in somebody who we thought would be a very value add partner for the next leg of growth.
Uh-huh.
And so they can sell outright, they can sell some, they can sell none. I mean, there's a variety. The goal is help them get where they want to get.
Awesome. So has that changed at all? Usually it's been 10 years, so that evolves as you learn things. And usually in the VC game, this created the impracticality of the venture game is funds got bigger because their fees got bigger and they wrote bigger checks and it got more impractical. But I don't know, what's changed in your approach, who you serve and how you help and how you and the founders exit? Has that changed in 10 years? There's been a lot of change in the
Look,
world.
the underlying market dynamics have certainly changed, right? You go from 16 to 26. As you know, we had
Yes.
a huge run up in B2B software valuation multiples, 18 through 21. Then it
Right.
came down 33%
Yeah.
and more. It's what we call multiple re-rationalization, if you want to call it that. And then, things were a lot harder in the markets 22 to 24, and things in
Yeah.
25 and 26 seem to be picking up, and I can certainly speak
Meaning
to
to
that.
grow and get customers and all of that?
Grow and get customers, but also capital markets.
I
The
see. Okay.
willingness of investors, the willingness of debt markets also to be there if you want debt, which is an interesting tool we can talk about that we've used with Practical Founders. Despite that run up and come down and volatility, our approach really hasn't changed much. As you said, we've raised more capital, but we still want to back, 10 to 12 companies in a fund, 2 to 4 a year. We're pretty selective and we want founders to be selective as well. And, that we want to stay in this part of the market. This is something
Yeah.
that's maybe different about us compared to other types of funds and investors is we love $5 to $20 million software companies. We love helping founders build.
Yeah. Yeah.
And so we don't want to be the $1 billion fund and kind of, be in a different market. We left those funds to come here for a reason.
Which means you're kind of a smaller boutique funds. Like people don't really realize there aren't that many funds that focus on this really hard work, you know. As far as private equity funding, this is the early stage, right? It's a lot
Yes.
of intensity, right? And founder, all that
Personalities.
nuance. Yeah, personalities and everything. It's not just a spreadsheet
Yeah.
game. But if you get a company to 50 million, there's 10 or 20 times more investors up there, right? Because that's the normal part, right? When it's just more easily spreadsheetable,
Yes.
the
Man,
finance takes over.
I came from Bain Capital. My co-founder came from Vista, the big
Yeah.
firms, the big brands, the big billion-dollar, multi-billion-dollar funds. This is where it's fun. What you do, what I do, is working with founders and building their businesses. And it's the most fun time to go from 5 to 50. The world is your oyster in terms of different levers that you can pull. So that's where we want to stay for the long term.
Great. So let's talk about what's changed in the market and your game and the founder game, the growth game in the last few years. And where are we at in early 2026, right? Venture funding has shifted completely in the last 18 months to at least half the funding is to just 1% of all the companies, the big ones, right? So that's one of the angles. And it's gone from exciting B2B SaaS to now that's boring. It's all AI first over there. So venture funding has changed. And there's a lot of thrash in there these days. Venture, most of the founders who raised too much in 2021 from venture capital are not in a good place right now, which means their funds are not a good place. So venture funding has changed fundamentally in the last 18 months. What has changed in your world let's just go through it here. AI has come in. AI in the product that's making amazing results and value for customers. AI in the business for amazing efficiency. I see that all the time. What's changing with AI in your part of the growth equity game?
Yeah, so AI has definitely changed things, and it's changing things every day right now. And I know that's a very cliched statement, but let me be very specific with it. We think, it is this technology that everyone's talking about that will, change how all of us do things. 5 years from now, the way you do things, the way you plan your personal family trip is going to be different than the way we do it now. And that is what we're talking about, the day-to-day things. What we're seeing specifically with AI with practical founder companies, Several things in no particular order. One, we don't think B2B SaaS is dead. So
Okay. Let's
we
just
think
call it.
that
Yeah.
we think that, it creates great headlines to say, AI eats software. We think
Mhm.
software plus AI is the right approach. Software, AI plus data.
Yeah.
And so, for hopefully a lot of your founders, they're harvesting and creating that data moat that is going
Yeah.
to help make them defensible and more defensible. And then using the AI tools, why not use the AI tools to provide more automation? That's what we really think AI does, is increase the ability of your customers to automate, the use of your product and to get value. And so, yes, every company that we're involved with has some AI initiative. Now, there's two different types of AI initiatives. Internally, how am I
Yep.
changing how I run my business? How am I changing marketing and sales and finance and customer success using AI? And so we are hopefully bringing best practices into the companies. I mean, all of them are experimenting. We're still in experimentation
Yeah.
mode, but every
Yeah.
company is doing something in every function in terms of new tools and tests. And then the second part of AI is, how do I bring AI enabled products to my customers? And so whether that's in the, facilities management space, whether that's in the fintech space, whether that's in the automotive space. And so we're building new products that have AI capabilities that use data in different ways. And so we're doing both. And so that's how it's changed in the last 3 years. I expect it to continue to change. Those new AI products, we're obviously in the process of figuring out how to price them.
Yeah.
We do think they drive a lot of, ROI.
Hmm.
Some are in their infancy, some are more mature. But I think for founders, it's a great opportunity to remake your business, both in terms of being more efficient internally. We think you can get 10 to 30% cost savings internally,
Yep.
but also bringing new revenue streams in, because you can still have your system of record or your
Yeah.
software platform doing whatever it's doing from a workflow or data perspective, and then add on top of it these new capabilities that you can charge for.
I totally see that in the groups. Lots of experimentation, lots of efficiency. More and more founders are saying, I think we can double without doubling our team and our expenses. Lots of crazy value. I mean, it's really exciting. I've been in the software business for a long time. I don't even want to say how long anymore, right? Since the early days of PCs, saw the internet come and SaaS come and everything, mobile. This is an amazing time to create amazing solutions for customers that are so great. Like software used to help us do things we did manually better. CRM, accounting, software, all that stuff. Now there's a lot of magic, like CRMs that do the prospecting and the qualification and the work. It's pretty amazing. I did three CRM 3 times, and I'm seeing our practical small founders create automated sales and marketing on top of their own internally
Well, and
created
and not
CRM.
to pick on anyone in particular, but I mean, this is why I think Salesforce.com is a little bit under siege.
Yeah.
They were the darling in
Yeah.
2001, 2003, whenever Benioff really started getting going, and they built an unbelievable business worth
Yes.
hundreds of billions
Unbelievable.
of dollars.
Yes.
But, horizontal workflow CRM with human beings inputting the data is being replaced, to your point, with agents and automation, and we call it almost the no CRM. You still need a CRM. You still need a database of customer records and contact and info, but not only that, all of the touch points. But if the machines can be writing into it rather than you and I sitting in the fields of Salesforce and doing it, I mean, it's a lot more efficient. And so that's obviously just one example, but to your point of transformation.
Let's talk about competition. So, do your founders that you in your portfolio, are they concerned about, I don't know, 4 people in India catching up, rewriting their full stack software that took them 10 years to build, or a new AI only magic, so, software coming in that does something sexy for their vertical customers
So
and
so most
penetrate?
of the
How are they
most
thinking about that?
it's a great question. I mean, most of the businesses we invest in tend to be deep in their verticals. And we think that that actually helps them maintain their
Yes.
defensibility.
Yes.
If you are, we have a subcontractor construction software business that works with certain specific trades, and you understand how to do concrete pumping better than anybody else.
Yes.
That is not something that a generalized LLM or a company, an upstart is necessarily going to understand. They need to know that industry, how it works,
Yeah.
how placing concrete works, and how they price it. And so we think the deeper you are in these verticals and the more, of course, data you have and the more, proprietary workflow information you have, customer information you have, you're going to be able to maintain that moat. Of course, there will be upstarts who try to come in, but the customer relationships and the customer knowledge and the ecosystem knowledge creates defensibility. And I think the broader horizontal companies are figuring that out, whether it's OpenAI or Google Gemini or others, which is the generalized models can only do so much, which is
Yes.
great. I mean, on the consumer side, but deep in these business verticals, how do you train a model if you don't have all the knowledge in the
Right.
vertical? And so that's part of our investment thesis in AI is software plus AI deep in a vertical that has and when we look at new investments, it's can this company sustain itself in terms of its defensibility because of that moat? But we're seeing a lot of really amazing, what I call vertical AI businesses,
Yeah.
where it's software plus data plus AI that are operating, for example, in the pro sports vertical, or in
Yeah.
the telecom services vertical, or in the pharma vertical, and doing really amazing things for those customers, and not really going to see, in our view, competition from somebody like OpenAI.
Yes. Yeah, I totally get it. Another thing that's changed, you and I have spent a lot of time together, the old days working together when you were on the board on the growth side. You were the only person on the board really talking about the nitty gritty growth game, which is quite difficult here. Go to market is changing, right? The tactics are moving around. Usually this is the challenge. I can get it to 1 million, right? Making stuff up in my personal relationships. I could get it to 5 million on one tactic, SEO, that worked pretty well for us that we figured out. But to grow from 10 to 20 million, it's, the bigger challenge is the go to market efficiency, consistency, reliability, and so forth. What are you seeing that's changing in go to market these days? And
I
that's a
mean,
big question. There's
to
a
your
lot going on.
point, AI helping every part of sales, marketing, and customer success. So let's take each one individually.
Yeah.
In sales, as an example, the ability to prospect or understand and get more richer and deeper information in an
Yeah.
automated way on prospects so that you waste less time and less
Yes.
money going after the wrong prospects.
Right.
Then there's other tools that help you to speak to more prospects or to follow up with more prospects in an automated way. So that's in sales, and there's 17
Yeah.
other things happening in sales. In marketing, the same thing, automating and helping you think through channel diversity. Obviously, there's a new quote unquote search engine, which is,
Yeah.
an LLM. So how do you do something like what's now SEO is becoming GEO, Gen AI, engine
Yeah.
optimization. And you have to have placement there because, more and more people are doing their searches on ChatGPT or on Claude. So being there, I think, is extremely important. And there's lots of other things happening in marketing as well, and attribution. And then in customer success, I think customer success and customer support is the first and most obvious area
Yeah.
for AI,
I totally
because
agree with that.
you can, from an FAQs perspective, from customer, getting back to your customer
Uh-huh.
immediately, obviously using agentic, and answering their problems. There's just so many things that can be automated in customer success and customer support with AI. So in go to market, again, every single component is being changed for the better. There's still a lot of experimentation. Every company's got to use the tools that make most sense for its customer base. And those customers also need to be ready. I was looking at an investment in software that was going to be used to help or is being used by telecom services companies to help their customers. And some of these are rural, telecom service providers. And what the CEO of one of these companies said is, my customers aren't ready to talk to an agent. An agentic or a machine.
Yes. Uh-huh. Uh-huh.
They want to hear somebody with
Hear that
an
a lot.
accent that sounds like theirs. And I will lose credibility if I move too fast to full automation. So it's this balance.
Right. It depends. Isn't that interesting? Right. It's always different. Yeah. So that's great. Can you generalize to say what fundamentally is different about go to market at 7 million than 35 million that founders can think about? What's up that mountain?
Yeah, in general, I would say the founder level evangelism. Usually 7 million is a founder and 3-4 sales reps. And there's
Right.
still the founder putting their back into, or one of the founders putting their
Yeah.
back into selling, and that there's nobody that sells like a founder. So that
Right.
evangelism, how do you, at 35, you can't do that as much, right? And the founder should hopefully always be involved in sales, but you can't drive as many bookings as you need. And so it's, how do you almost create that founder, selling motion and replicate it and scale it to 20 sales reps or 20 customer success CSRs. And that's, the big change. And so then it's all the systems and the management and the compensation plans and the tools to go do that. And that's really what we focus on, to your point,
Yeah.
is as you go from 7 to 35, something's got to change. And the way you got there isn't the way you're going to get to the 5x the size.
What's happening in the end game, right? You started your firm and raised some funds and started investing in these practical founders that you've been doing, and they grow and exit and everybody gets paid back and founders win, their second bite of the apple. Is the end game changing? It has for VC funded firms. They're not going public like they used to. They're not getting acquired for the multiples they used to. But what's changing in the practical game for companies that get to 30, 40, 50 million and want to take the second bite and exit again?
Yeah, I think not a ton has changed in terms of exit options, but what's
That's
changed,
good. Yeah.
what's changed it, like 22 to 24 was the veritable, desert as it relates to, liquidity events.
Yeah.
We, speaking as a firm, after December 22, we didn't have liquidity for any of our companies until, the end of last year. So 3 years of a desert. And that was driven by a number of things, right? In terms of the renormalization of multiples, the debt markets went through a big tailspin, and they're in a
Yeah.
much nicer, better place now. Interest rates are coming down, obviously. Private equity capital is at a record high in the technology space. So we think 26, 27 is a great time for founders
Okay.
to be considering liquidity, investment, et cetera, if they want it. If they want to sell, there should be a buyer, or if they want some liquidity. And so, but in terms of the approaches you can take, private equity's back in the market. So you can do a
Yeah.
recap, or you can do a sale to private equity. Strategics, I mean, look at the NASDAQ at all-time highs. Strategics are backed with corporate development teams needing to buy, particularly to your point, and I know it's been bandied about, but the quote unquote old SaaS companies need new innovation. You see ServiceNow as an
Yeah.
example buy 3 AI companies for
Yeah.
billions of dollars in the last year. It's because they're viewed as one of the quote unquote, it's funny to call ServiceNow legacy
Yeah.
companies, and you need AI. And so there's a lot of acquisitions happening. Some are in, of course, native AI technologies, but others are, I need something, or I need an AI-enabled technology. I need to modernize. So we're seeing a lot more strategic M&A activity as well. But I think the market's in a good spot.
Awesome. Well, I mean, this is just as a reality check for practical founders that say, gosh, if I just build a compounding machine that's break even, a little bit profitable, growing 30% a year in my unsexy corner of the market, and I do right things for customers, and I impress them with AI value and get more efficient with AI value and build all that company building stuff along the way. There's kind of that compounding dotted line practical founders have in their head that someday I'll get it to X, and either it'll be profitable for me or valuable for somebody else. And what you're saying is all this is pretty consistent right now. You didn't change your spots, just more AI, do it better, faster, cheaper, right? And the beginning and end games still work, and industries still need specific solutions, and practical is in compounding still is pretty cool.
I think to some extent it's more opportune to be practical right now. And
Yeah.
and the AI automation is making it cheaper and easier to build a business
Yes,
without outside
absolutely.
capital.
It's very
And,
practical.
if you get AI-enabled coding, hopefully you can get there faster and build more features faster as well. So I think it's a fantastic time for either new founders or founders in that 5 to 20 journey to be innovating and testing these things. And to your point, yes, the markets are there, and the approach is better than ever. To your point about VCs, I mean, again, I have lots of friends there, but we take a very different approach. it's a different thing. Andreessen Horowitz just raised $15 billion. I mean, that sounds like a buyout firm, not like
Yeah.
a venture firm, but because they want to put billion-dollar bets into companies like OpenAI.
Yeah.
And, most founders, 99.99% of founders don't want to take that approach.
Yeah.
And so it's certainly not for everyone. In fact, it's probably for the certain percentage that want to take that approach. So anyways, we think, obviously if it makes sense, growth equity can be an interesting path. But to your point, some founders build their businesses all the way to the finish line on their own. I mean, I
Yeah.
know there's a billionaire in Madison, Wisconsin who runs Epic, the
Yes.
EMR business
Yeah.
that
She's great.
she built it all herself. So, I mean, there's no one way.
Yeah, that's kind of the motto of Practical Founders, no one way. And so you have now 18 founders you've worked with, and I guess they're still active. Most of those haven't had a liquidity event or an exit. How do those founders help each other? This classic problem, like my Practical Founder peer groups, it's lonely to be a founder. It's bootstrapped, especially. Go over there in the corner. That's the good news. The bad news is you don't get a lot of perspective. You don't get a lot of support. Do the founders work with each other? Do you foment those peer relationships in your portfolio? That is one of the advantages, I would say, of being in a portfolio.
We completely agree with you. Your model is our model. We bring together actually on a functional basis CEOs, CFOs, heads of people, heads of product and
Oh,
tech,
wow. That's
and
great. Yes.
heads of revenue. Because if you're building this company, say between the $10 to $50 million band, and think about it in this world of AI we just discussed in terms of experimentation, this CRO who tried something that's working really well
Yes.
should be able to help this
Exactly.
CRO, should be able to help that CRO. And that's just one example. There's so many practical lessons. How much did you pay for this vendor? Or, what's your comp plan look like? Or what, that all of that we try to make sure gets shared. And sometimes, so we do quarterly meetups in between those functional heads. But then in between, we have these Slack channels where they're asking questions to each other.
Right.
Sometimes if they don't want to put it in a public forum like that, they'll ask us and we'll go and collect information and give it to them from the other peers. So the concept of it's a community of information and resource is a big part of how we built Wavecrest.
Okay. Anything else out there that you're seeing? We're both keeping track of what's going on day to day in these markets and the growth game and the founder.
The one area that I think was a little bit forgotten that I think we're seeing a lot of resurgence in is what I'd call predictive analytics. It was a term bandied about 3-5 years ago, but the combination of AI and predictive intelligence and data co-ops we think is really interesting. So we have several companies that have third and first party data, obviously training their model, but then using, the old term pre-AI of machine learning to predict outcomes and drive, differentiated results. So, maybe that's an area that some of your founders will also have products in or experiment with.
I do see that. And the more data you have, the more AI for generative automation you could make, but there's still the amazing insight that says you ought to be able to look ahead and see what's going to happen a lot better, or get that old analytics, actually know what's freaking going on, right? All of that. So
exactly.
That's awesome. Well, how can people who want to have the conversation? I know you talk to hundreds and hundreds of founders a year, including some of the folks in my peer groups that are interesting to each other. How can people reach you to have a conversation? Maybe to try this on, see if it's a fit. And they don't have to do anything.
They can come directly to me.
Yeah. Okay.
Happy to email me, Deepak at wavecrestgrowth.com. They can come through you. They can come through our website. We love talking to founders.
Yeah.
It's what you do. It's what we do. I want to do this for the rest of my life, is just work with founders on their problems and be that sounding board. So we're all ears, anyone who wants to have a conversation.
Well, awesome. Thanks for all your work, your success the last 10 years building. And, your Fund 3, that's a sign that your model is working. And serious people are doubling down, and you've built a team. And I know some of the team members. Really exciting to see you go from a bootstrap startup to, I guess you're scaling up now, right?
Yeah, we're 18 people now too. So we're in that bootstrap, mission and 10-year journey as well. But to your point, I mean, it's the most rewarding thing for us is seeing the founders we backed 7, 8, 9, 10 years ago being at multiples of their size. I mean, we have companies that started at 7, 8. We have one that's now 200. We have several that are, 60, 80, 100 in revenue. So I'm just so,
And that's a
humbled
really
by
big win for the founders. They had skin in the
unbelievable,
game. They kept a big
unbelievable.
chunk of equity, and
Yeah, and
it's
they
a
all
really good.
own double-digit percentages. And one case, the founder owns still the majority of his business. That's 10x the size of when we invested. And God bless him.
God bless them. Very exciting. And there's the other thing too, which isn't just the spreadsheet math in your bank account. It's I changed an industry. I led a company.
Yes,
I moved the world, right?
I
And
hired
I turned into a CEO, right? That was capable.
I created lots of jobs and changed lots
Yeah.
of lives.
Yeah, it's very exciting. The growth game. Awesome. Well, great to hear from you, Deepak. Thanks for all your insights. Thanks for all you do for practical founders out there. And thanks for being on the podcast today.
Thanks again, Greg. It's awesome to be here.
Thanks for watching this week's interview on the Practical Founders podcast. Be sure to like this episode and subscribe to the Practical Founders YouTube channel to keep up with my weekly in-depth interviews with serious software founders who are building valuable software companies without big funding. You can check out my blog, all the podcast episodes, and information about my Practical Founders CEO peer groups at practicalfounders.com, or message me on LinkedIn if you'd like to connect. See you next week.